Eagles, TGIF, how's everyone doing? Good morning, Dan, my trading warrior brother, Patrick, my trading warrior brother, everyone, my trading warrior brothers and sisters. How's everyone doing? For people that aren't subscribers, active patterns in play, a lot of great trades working here. Blake, only one negative right now, and a lot of them are up a ton. Greg recommitted S&Ps up 3%. Been riding the Aussie down 2.3. Some nice trades in the pattern and play. I think everyone should have had a pretty good week. The big change and shift yesterday was, I believe the dollar has turned. I'm going to be interested to see what my teammates think. You look at it on a weekly basis. Yesterday I talked about the divergence here. Okay, and the Dixie up here, and Steve have been talking 91. Close enough for government work. So what kind of week are we having? Kind of a reversal week, way off the range. This may have been it up here, and we could now flush to new lows under 88 in the coming days and maybe a few weeks into maybe spring, something like that. A lot of bears are talking 84. I'm not that bearish. I'm thinking maybe just one more flush down here, 87-ish, 87.5. So it's going to be interesting to see what the reaction is to the Italian election. When I look at the euro here, you have a positive week. What I'd like to see is maybe a little bit of some, mixed results. It's not so, it doesn't give euro relief and generate some type of pullback towards the 22.40 level would be a great area to consider long positions between here and there next week on maybe some election noise, and get long the euro, because to me the euro is going to hit new highs. I know Grega has objectives at new highs in the euro too, 27-ish, I believe, 680. So that was a big change, and with that happening, had very interesting action in the precious metals. Very classic type of stop hunt. Where are you guys? Here we are. Okay, I think the silver was a real classic stop hunt. See the spike low right here? So it was just enough to shake out the bulls that had their stops under 16.16 and turned. We'll see. It doesn't hold this low. The precious metals are in trouble, but I believe they will. So I'd be looking for pullbacks. Actually, silver outperformed the gold yesterday. Today it's the opposite. Gold's outperforming the silver. Same type of setup. 1310 was an important area for this rally. We took out all the bulls that had stops here and now trading better. So my bias is to look to buy breaks. Just a quick encapsulation of the S&Ps. Steve was bearish, Blake was bearish, we were even bearish up here, and then if you didn't have the guts to sell it in this zone up here, the conservative thing I pointed out early in the week was short the first close back under 61.8, so you did it at 27.41. You have almost 100 handles in the S&Ps making new lows here. I believe I went into the trade room early in the week and said, all I'm hearing, all I'm reading, all I'm seeing is that these lows are in the S&Ps, makes me think it's vulnerable for a washout. So a lot of people might be expecting a turn on Friday because that's what happened down here. Maybe it doesn't happen this time. People counting on maybe the plunge protection team to come in. Let's see if they do. Next stop looks like 26.14 or so, but definitely a negative week in the S&Ps, all indices, outside weeks. We took out last week's high, last week's low, and on the verge of, I'm thinking a turn next Tuesday. Perhaps a weaker dollar will kind of soften this, unless we just have a crash and take it down to 24.10, which is would be a classic equality move of A, B, C down here, clean out the lows, and then have set up a rally for another rally to new highs, which is what I think could happen. Also, the crude was another one. So those were my two best forecasts of the week. They were both pretty good winners. So crude was trading up here, up around 64, pretty negative week. The contention was that this was going to be a failing rally, not take out these highs. Crude's holding up a little better than the S&Ps. I still think there's a possibility for a move down to 54-ish, another type of equality move to the downside. And that's it. I think everyone should have a pretty good week. Steve tweeted me that everyone in FACE was not surprised by the sell-off in S&Ps. If you agree with what Steve said, give me a Y. Okay, and I also was saying, you know, Steve, besides the S&Ps, I really don't think there were any bum steers. We were bullish $1, bearish euro. Blake, you know, talking about the false breakout. The turn happened yesterday. Even called and blogged about a bounce, a bear market rally in bonds, and that happened. We're bearish commodities, which were under pressure. So I think that the input happening here for free for you guys has been top shelf. Stick around for our interview today. I have my good friend. I've known Jim Welch for, I don't know, maybe 30 years, 25 years or so. He's here in the San Diego area. He's one of the better market letter writers, tacticians, specializes in sector model. So Jim's going to be addressing the euro, bonds, and indexes, and I'll try and pull out some ideas on the indexes from him and possibly the precious metals, which is something else he follows. So always a great interview with Jim Welch. He's coming with armed with charts to make his case. And with that being said, I want to pass it on to Blake. And Blake, we never got to 121 in Euro USD. As you know, W.D. Gann said, if you don't learn how to change your mind, you won't have any change left. Has your mind changed about the dollar and the euro, or do you still think that we could see 121 again? Calling Blake Morrow. Calling Blake Morrow. Okay, Blake must be busy. Steve, are you around?
Oh, I'm talking. I had my microphone on mute. I was like, man.
Oh.
Can you not hear me? No, I was just saying that it seems like a distant objective now. So I got to tell you how I traded the euro yesterday. I mean, I was on the short side, covered everything, did really well with the euro yesterday. Here, let me pull everything up, and then I went to, and you guys might have seen my tweet about. You guys might have seen my tweet regarding. I went to a baseball game yesterday. Did you see the spring training game, Dale? Did you see my tweet?
Oh no, I didn't see it.
Oh, okay.
What the Cubs train there? What is that?
Well, yeah, they do. But I was at Salt River Fields where the D-backs and the Milwaukee Brewers.
Oh. So okay.
My friend, good friend, matter of fact, a family that we're vacationing with here in a couple of months. The wife, she was singing the national anthem. So.
Oh, cool.
Yeah, it was really cool. So I got down there, and I had leveled all my positions, and I'm like, okay, I'm going to leave for an hour and a half. I'm just going to go. I had to go run there, support them, for the national anthem, and then I watched like 2 innings, and then I came back because I had to do ForexAnalytix analysis for the evening. So I didn't stick around long, but I went there and I'd closed out every position. and in the euro, and I was out. I went in and I put in an order to sell the euro dollar at 122.55. So I had a sell order right here. Okay.
Yeah.
All right. So right there, I had an order. Wait, hold on.
Okay.
ECB. Oh no, China's trying to ease trade tensions with the U.S. So I don't know how.
Yeah, they're going to try. Well, we're at new lows in the S&P, so it's going to be interesting. Everyone in the Trump administration came out against. He really surprised everyone. All of his advisors are against this, so pretty interesting. If he pulled back his horns on this, which I'm not sure he will, God, the market could fly if that happened. But I mean, his whole cabinet is against these tariffs.
Yeah, well, once he sees the market's reaction to this over the coming weeks, he may, he may rethink his stance, but we'll see. Anyway, what I was saying is,
Powell can't even help him with that. Okay, I mean, it's not a monetary issue, so the Fed doesn't have the same amount of power to stop the flood when it's, a political stance.
Yeah, and especially regarding trade. But I'll get into that here in just a second. I just wanted to let you guys know that I yesterday I left and I put in a short to sell the euro right here at 122.55. I got short as I was actually at the game yesterday. I got back in front of my desk and it was trading at like 64, and I'm like crap. And it was right here where my mouse is, and I'm like, I got back in the chat room. I'm like, listen guys, I got to short the euro dollar. I don't like it. We had a bullish engulfing candle in the euro and I closed it, and then I turned around and went long, and I said I'm gonna take it long overnight, and I just got out this morning when we spiked up towards 123.10. So I made this gain overnight, and I'm already out of the euro dollar. But I took a small loss because I got in a trade when I was at the baseball game, and then I turned around and I said that's not the right trade, because we had this bullish engulfing candle right here. And then also, do you know what else made me decide, Dale, that I don't want to be short the euro? Do you have any idea what the other thing that was my decision making?
How about a false breakdown under 122?
No, Grega.
Oh, Grega. Yeah, I brought it up. Grega bought it.
Yeah, he at the end of the day yesterday, he put in a pattern in play, and I'm like, oh crap. And then I read his analysis. I'm like, damn it, I'm going to get out of my short. That was like the deciding factor, but it was a nice hammer, bullish engulfing candle. And I said, you know what? I don't want to be short. I want to be long. And so I turned around, went long, got out of it already, because we have the Italian elections. We got the SPD vote. Although, what's expected, we got to worry more about, what's probably going to happen is that one of these parties is not going to have a grand coalition, or the equivalent, like if you're here in the United States, like a Senate majority, so that should continue to be euro bullish, even following the Italian elections. But then there's that outside chance, like the Grillo's party could, I think it's a 5-star movement, could, swing like a 35% majority, and then, or 35%, and then, the euro could be really under pressure. But I don't think that's like possible or really expected. But there are risks obviously in the euro. But technically, what we're doing is we're challenging the underside of this trend line right now, and that's the issue. And I think if you're long, you've got to be careful with this. you know, it's interesting, all the analysis I read from the banks last night after I got finished with all the ForexAnalytix analysis was like, now, you know, most people are expecting the euro dollar to go to new highs. And with this false breakdown that you just mentioned, Dale, I wouldn't be surprised to see this now. Here, let me actually change. I wouldn't be surprised to see this.
Yeah.
In the euro dollar. Yeah. It posted that false breakdown, and now we're in, I wouldn't want to be short. Let me just put it that way. I'm actually long some euro Aussie. If you guys are ForexAnalytix subscribers, you've seen this cup and handle pattern. If you're not, this is the first time you're seeing it. You're now 50, 60 pips behind the ball, but still, I mean, you know, you look at the euro Aussie and where it could go. Keep in mind that this consolidation has been the entire month of December and the beginning of the year. Beautiful development here in the euro Aussie.
That's a risk-off trade, right?
It is a risk-off trade. It's a euro bullish trade. It's a bearish aluminum imports tariff trade. It's a trade that has everything lined up for it right now. There's not a lot of times that you get in the market and you go, I can't really argue this trade at all. You know what I mean? Yeah. It's
pretty defined. The only thing with pretty clean now, especially that negates the breakout. Then you got to get out of the way. But yeah, I mean, that's a beautiful pattern. And
it's got
moves nice.
Technically, it's got a great setup. It's got a perfect setup from a risk reward standpoint. I mean, your risk is below.
The pattern and plays this week were great, Blake. I went through them at the open.
I think we've got some good ones out there. Stelios and Grega, and Andre put his first one out there, but he's very by the book. We've got some good ones setting up. But again, I look at the euro Aussie and I all I have to say is the dollar's bearish because of this tariff news. The euro has the potential to, after this weekend, to really start moving higher after we get past this weekend, and because of this this potential trade war that we've got brewing, the Aussie is going to be one of the currencies that are going to underperform, and so the euro Aussie, and then technically it looks beautiful. So there's not a lot to me that suggests that I shouldn't be in this trade. The only thing that's going to disrupt this trade at this point is below 156, and you can see where your targets are. They're well above 162. So even right now it's getting close to a 1-to-1 risk reward ratio, but still it's still favorable at this point, and it looks quite possible that we're breaking out. Now, if you understand, if you go, well, Blake, God, we're up near recent highs. Go look at historically where this euro Aussie's been. Go take a look at this weekly chart, and then go back to pre-financial crisis. When we get risk off, you want to see what happens when we get risk off? This is what happens. Okay. We get risk off. I mean, this thing could be, trading up in the 170s, 180s in all actuality. So I think it's a great setup. So this is where my focus is right now, and I'll be adding to it after this weekend, as long as the euro is not getting completely pummeled. On Sunday night, I will be adding to this Sunday night. So that's my trade right now. That's my trade that I'm really focused on.
Does that turn you friendly on the metals here, Blake?
Well, yeah. I mean, gold. Well, let's talk about gold for a second, and silver. So gold hit the 50% retracement. If you guys use ForexAnalytix, you already know this. We hit the 50% retracement, false breakdown below the support. Looks very bullish now, right?
Buddy, thank you.
Yeah, it looks really bullish. Now, silver, same deal. We did a false breakdown. We did a false breakdown below this this very minor trend line hammer yesterday. It looks like silver could take off too. I'm not trading the precious metals at this moment, but they don't look. They look, you know,
like they have a shot.
They do. They really do. But those look pretty solid. The pound, I'm gonna have to pat myself on the back here with the pound. I did exit the pattern in play literally at the low. We hit 161% extension, and I don't like to pat myself on the back often like that, but I have to admit that I had a pretty good exit right there. I was actually sitting there waiting for it in front of the computer. I was like, yeah, we hit a new low. Relative strength started to relative strength was really divergent, and I'm like, all right, that's the low. And but I would like to be short the pound again. But with the dollar weakness that we're seeing right now, and I know, you know, the dollar is bouncing a little bit here, but with the dollar weakness that we're seeing, the overall dollar weakness, the risk of the pound dollar, you know, bouncing back to 138.50 to 139, I think it's possible, and I'd be a seller up there. I think that any rally into, you know, this 138, 139 level, I'm going to look to sell into if we can get an opportunity to get it. So does
that have you positive euro pound, Blake?
Yeah, and if you haven't seen the euro pound, it is squeezing, and it's finally breaking out of this range. We've been very much range bound since the beginning of the year, and you can see really since this is early December, the highs were posted in January. So we've been really since the beginning of the year very much range bound, and we just popped stops through those highs, but. You know, I'm looking at the euro pound. I've been really wanting to be on the short side of this, but I you know, looking at it right now, I mean, it looks like we can do this.
I think we're going to new highs for a third drive, Blake, before it's over.
Really? Wow. Yeah. I mean, we could. We could.
No, that's what I've been saying for a few months.
Everything that's happening with Brexit, I think it's possible. Hold on, I just need to cancel an order. I just scalped the market for life.
I'm through interrupting you for the week.
I just bought the Canadian yen just moments ago, and I sold it for 8 pips. I'm such a wussy. But okay, so let's talk about this because I tweeted the chart, so I might as well just go ahead and, you know, talk about it. So we had a double top. I've been bearish the Canadian yen. Like if you read the ForexAnalytix analysis for the last 2 weeks, it's been like double top. We're going lower. We're going lower. We're going lower. We're going lower. We're going lower, and it's a double top. And you know, well, we completed today, and this is rough. I mean, I could you know, be a little bit more granular on my analysis here. You know, it's pretty damn close. But notice where we stopped this morning is at the 88% retracement right here. And so what I did is I just
granular. I love it.
Yeah. Well, we hit the. It hit the. I got a few words in my vocabulary. Not very many, but I got a couple. We hit the 88% retracement and really oversold. So I picked up the Canadian yen just made 10 pips just moments ago. I just, you know, in and out kind of. When I go counter trend like this, I don't like to do it that aggressively, and I won't stick around very long, especially after such a steep sell-off. But and especially under the current circumstances, so I wanted to get out really quickly. But anyway, I already in and out, already been there, done that. I made this move from there to there. That's it. So, but the Canadian yen looks really gross. And probably could go lower. I would think that any, you know, 40, 50 pip bounce in the Canadian yen is going to be sold. So that's just something to think about. So we've had a lot of really great moves. You know, I would be very careful with the dollar. The dollar might get a little bit of recovery this morning, but I'm selling any type of significant dollar strength. I don't know if I will be long the euro dollar going into the elections and into this weekend, but as I've mentioned to everybody in the chat room for the last, you know, 12 hours, and then, you know, I'm going to tell you guys Sunday night, as long as the Italian elections aren't a debacle, and as long as the SPD vote is, you know, not too negative for Angela Merkel, I'll probably end up buying the euro dollar on Sunday night. You know, now if it gaps up 100 pips, I'm not going to. But you know, as long as the euro is not too out of control on Sunday, you know, even if it gaps down a little bit, or you know, we're not, you know, too far off of closing price wherever that may be today, I'm probably going to be a buyer of the euro dollar on Sunday night. That's what I'm thinking.
Well, I dropped into the chat room, and I'm seeing things like what a great team we are, and people collaborating it, and Amanda killing it. What a great community it's becoming.
You know, it is. We've got so for those of you guys that don't know, the chat room that you see there is that I don't have it up on my screen right now, but let me move it so you guys can be on Jumbotron. There is a group of about I don't know. Well, first of all, this chat room was in existence for a year after I left Wise Trade. It was just I set up a chat room just between, you know, 30 of us that we've been chatting for years, and it was just free, and I just, you know, left it there for everybody that I had been chatting with for the last 10 or 15 years. Just left it available for them, and we opened it up to subscribers about, you know, a couple months ago, and now we've got, you know, over 100 traders in there. We're all talking about, you know, well, oh, Bill's putting up, okay, Bill, all right, I got to get rid of that now. So Bill. So anyway, we have a lot of great traders. We, you know, talk, we mess around, you know, some, but we, you know, talk markets and charts and what we're doing. And, you know, I'm always talking about what I'm trading, you know, what I'm selling, what I'm buying. And, you know, don't have to worry about, especially, you know, on Twitter. I try to limit what I do on Twitter because, you know, just, you know, some of the comments that we get, just, you know, I don't even like to deal with it. And in the chat room, we've got, you know, a great community. Like I said, some of the people I've been chatting in there with for 15 years, and they've been with me, you know, through thick and thin, up and down. They've seen my hot streaks. They've seen my, you know, when I'm down in the dumps. And which, if you ever hear anybody that tells you otherwise, it's not the case. Anyway, it's a great community. So thanks, Dale, for bringing that up. I just realized it's 1 minute here before. Yeah, we have some Canadian GDP data. So I'm going to flip it over to Steve. You guys have a great one, TGIF, and I'll be here because I want to listen to Jim. Jim's probably one of the sharper guys that you bring on consistently. He's a really great economist. So and the guy gets it. So he is. Okay. I will be listening in 30 minutes. So thanks, guys.
Buddy. Great week, Blake. Good leadership. Nice trading.
Thanks, guys. Hey,
and as Steve would say about Jim Welsh, indeed.
TGIF, guys. Thanks.
Okay, Blake.
See you later, Blake.
Steve, great trading this week, man. So yeah, you caught a couple of real big waves in indexes. I'm just want to congratulate you. And
yeah, it was
Palladium
a nice week.
and everything. You know, I think you need to put out more patterns in play.
You know, for example, Palladium is not something we cover in ForexAnalytix because we can't cover like 1 billion instruments. Plus, I'd rather leave Blake do the basic technical analysis patterns in play, because my trading style is not the friendliest one for patterns in play, in the sense that I scale in multiple times and scale out multiple times. You know what I mean? And patterns in play are theoretical, so we put one entry, one exit. You know what I mean? But as you very well know, I constantly always promptly write whatever I'm doing in the chat room, so people there, know exactly what I'm doing and when I'm doing it. So let's have a look at Canadian data.
Nice trading, bro.
Canadian data is okay. It's in line, basically.
I don't think so, Celio. 1.7 versus 2, because it was expected to be 2.
But you're looking at the annualized, the quarter on quarter.
Yes.
I mean, month on month and quarter on quarter. Yeah, fine.
Yeah, it was a little bit weaker on month. Yeah, but anyhow, we're not seeing much of a reaction here in the USD CAD. Keep in mind that we warned about USD CAD turning back here when we had this descending wedge. I remember, I think it was a Friday, I said that, listen, 124.20 is a very critical zone. If we break above it, the Canadian recovery, the USD CAD recovery, can have legs. And we said that the next level of resistance is 126.60. Indeed, it played a role for some time. Then we said that after that we should be looking for 127.80, and we've said that above 127.80 is the 121, 129, 129.20 zone. And yesterday we actually tagged the bottom of that zone. This is the next resistance. If we break above there, the next area is 130. And then we have the 61.8 at 131.30. So bottom line,
it's sure holding up great with a dollar, a little bit with dollar weakness the last couple of days. Pretty impressive comeback.
Absolutely.
So we're probably going to that 31, huh?
Yes, it's very likely. It's very likely, because the Canadian dollar by far has proven to be one of the weakest currencies during the past several days. So absolutely, it's one of the preferred currencies to be short against, whatever you deem to be strong at the moment, right? Now, for how long that's going to last, as we were saying yesterday, Dale, it's also crude is also going to play a role in that. So depends on what we do here with crude. If we move lower for one more leg down towards the 55 area, then I expect this Canadian weakness to resume for several days ahead. Now, if we see crude reverse from here and push to new highs, which seems less and less likely, judging from the structure, then we might see Canadian, get its footing back somewhat. But I do believe that the USD CAD indeed looks likely to push, of course, not in a straight up move, but to push towards the 61.8, which will be a very nice level, like, there 131.30, 132. I think, a very nice area to start looking for more weakness in the USD CAD once again, right? Before we go into these commodity currencies further, though, we have some very interesting patterns and charts I want to show. We were discussing about them yesterday in the chat room as well. First of all, USD yen. If you remember, we made it clear yesterday that what we had in mind of this structure is being a triangle. Yesterday, I wrote European night hours in the chat room that USD yen seems to be doing the move and breaking below the triangle, and that will definitely bring more downside. As you see, we did get the expected follow through, so this indeed proved to be a triangle formation, and it's working textbook as expected. We're currently testing the 127.2 of the last move higher. And I have to tell you that if this zone does not bring a reaction, as I was saying yesterday, I see a pocket of thin air here. So in essence, I don't see much that can stall it before we reach our next objective, which is like more than 250 pips lower. It's a 161.8 extension at 102.73. And below that, we have the 150 horizontal support. So bottom line, there is no question about it. USD yen remains weak, and there is nothing here that hints a strong rebound or whatever. So, you know, stick with a short-term trend, which is lower. There's no question about it, until it proves, you know, not to work anymore. Obviously, given the risk of move we've seen as well in the markets, it makes sense that the USD yen should remain under pressure. Now, speaking of indices and the rebound, I almost got hit on my second target today, but I haven't gotten hit yet because I have a limit order at 26.42 to take off, you know, the rest of my short for roughly 4.5% profit. We're not there yet, so I'm holding half my position. I got rid of the other half at roughly 2700. I think that we will soon know what kind of a structure we have here. Bottom line, is this, after a big sell-off, some type of a consolidation before moving to new highs? Or is it something more than that? I mean, there are three scenarios. The most bullish scenario, and if you remember, I was repeating the same exact words since we found the double bottom, the most bullish scenario, because in my mind there was never a scenario that we will rebound and head to new highs, is some kind of a consolidation between the all-time high and the double bottom that eventually will break to the upside. But it's going to need time to do that, right? Second scenario is something like an ABC that's going to push to new lows, perhaps towards the 2400 area or the 2480 area, okay? And then start recovering. And obviously, there's the third scenario that we found a significant top, in which case, you know, some type of a bear market might have already started and be at the very first steps. Statistically speaking, the third scenario is the one that has the less probabilities, right? So now the question is, since I don't want to be taking into account low probability scenarios, is this going to be several weeks of consolidation, or are we about to head to new short-term lows? We're going to know that quite soon, because in my opinion, if this is to be some kind of a consolidation, we should probably not violate this zone, roughly the 2600 zone. So if I see a move beyond that, then I'll start believing that the chances for a push towards 2480 or even 24 are quite high. If we actually stabilize above the 2600 area, then my main scenario will remain one of a choppy consolidation that might last even for several weeks before we see the markets recover once again. Okay, so I think that probably next week, because I think today is not very, very likely to be a day that's going to, you know, push S&P, for example, below 2600, although you never know. I think that next week is going to be very significant for us to know. Okay, and you know, no matter which index you have a look at, you can see the same deal. The Dow Jones, the Nasdaq, the IWM, Nikkei. On the other hand, I think Nikkei, DAX, FTSE have been even more clear because they have a more bearish structure. So, in my opinion, for example, Nikkei printing a lower low than the one we got at the 9th of January is quite more likely. Same applies with DAX. I said it since we were testing the 38.2 area. Same applies to the FTSE. Okay, as you've seen, that's what we drew in all of them several days ago, and as you see, they've been going according to plan very nicely. As you see, whenever you have volatile markets, you have more clear technical structures, and it's much easier to trade, much easier. I mean, if you see, our patterns in play have been extremely successful, and our trading has been extremely successful lately, simply because when you have no volatility and no volume in the markets, and you only see liquid moves, usually you get, you know, very choppy and very noisy price action, and choppy and noisy price action does not usually create clear technical patterns. But when you do get markets moving, you get more clean technical patterns, and it makes your life so much easier to trade. And that's why people should also work very much on choosing their trades carefully, which also means that there are periods of time that you should be trading less and perhaps with much less leverage, and periods of time where you feel comfortable that you can push on the throttle, and because you know that your chances of performing are much higher. So experience helps you choose more wisely when you have period A or period B, in essence. Okay, so having covered the yen, which, as I said, is obviously a very important development in the markets, needless to say that given the fact that commodity currencies are not having an easy time, so for example, the Aussie, the Kiwi, the Canadian, as we've shown, etc., 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 and given the fact that the USD yen is severely under pressure, you can understand that it's obvious that we have a situation of more or less a bloodbath happening in the vast majority of the crosses against the yen. So, for example, have a look at the Aussie yen. We warned several days ago that I remember showing, perhaps even it was a couple of weeks ago, and saying that, listen, be very, very careful, because the Aussie yen, having broken below this formation, is now clearly in bearish mode, right? And we said that the next area of support is this one, and we are currently here. So just to understand how important this is, just look at the big picture, right? I mean, you have every reason to believe that this was the move lower, this was a corrective move higher. The structure is clearly corrective, right? Overlapping, slow, and boom. Same situation if we go to the Kiwi yen. Okay, a little bit less bearish, but regardless, it broke below this trend line. It's currently also challenging this low. Just look at how big this pocket of thin air is here, right? I mean, if you tell me that in a few months from now, it's going to be trading here, I'm not going to find it really hard to believe. And needless to say, the biggest fake of all was obviously the CAD yen, because the CAD yen created expectations of an inverted head and shoulders formation. There it is. With the neckline being that, it broke higher, but then, that's why you need to pay attention to everything when you're looking at technical analysis, because, okay, that was a technical formation, but, you break higher. But what are you seeing here? Do you see anything in the long term that implies something impulsive? Is that impulsive? No, it isn't. So then you're forced. You're forced to view this also as a bearish consolidation that has broken to the downside. Go ahead, Dale.
Oh yeah, I'm just curious. I know one day a trend does not make, but I know you were still negative before the reversal in metals yesterday, and I'm also curious if dollar's action yesterday changes your view that maybe this is it, the beginning of a pretty good decline where we could make new lows. If that was
first of all, I need to remind you that I finished the conversation with metals, especially looking at the silver chart and saying that people be very careful here, because I need to remind you that silver mostly, but even gold, have been more or less, if you look at the long-term chart, without a trend, right? They keep producing violent moves contradicting with each other to both directions. And if they've done something successfully during, the past several months, is fake people out and take your money away from your pocket, right?
Yeah, it's been choppy, but
yes, exactly.
Yeah. So, but to me, I see a few stop hunts in gold and silver.
Absolutely.
You knew there were a lot of stops under 1310, and I think it
absolutely.
was,
Yesterday, for example, we were showing like we were about to break below this potential triangle, and just look at the end of the day, what kind of a candle we got there, right? Like,
what do you call that candle?
This is a pin bar, first of all, as a general category. It's a pin bar. The specific one is a hanging man, but given the huge lower wick, you should more or less read it like a hammer, albeit a black colored one, right? Traditionally, by the way, traditionally bullish candles are called white candles and bearish candles are called black candles, because back in the past, that I'm just saying for people I know that that we didn't have computers, etc. They were using, they were drawing candles with a pencil. So in essence, it was either black or white. So if you didn't feel it, it was white, and that was a bullish candle. If it was filled with pencil, then it was black, and that was the bearish candle. So technically speaking,
maybe that's where we got the expression "back in the black," because the black candle was, was it bearish?
No. Yeah, black candle is bearish. Yes.
We know on that. It's not.
yeah. So probably it doesn't come from there. Yeah.
So what do you think? You think this could end up being an important turn, and we head back up to 1360 and finally get the breakout?
In all honesty, mate, I really don't know. I mean, this has been faking people so much that I'm just, I made several attempts. I lost money in one. I made money in the other. I got at break even on the third one. But I realized that I'm spending more time trying to trade it and end up not just not losing money, then it's actually worth it. You know what I mean?
So yeah, that's a great point. You have windfalls trading indexes and yen crosses and commodity currencies, and gold is rangy, and it's not worth the energy.
Yeah, that's why, as I told you yesterday, what did I do? I turned to palladium. Why? Because palladium had a much cleaner technical structure. So, I made $46 here. I mean, from 1,046 to 1,000 that I got limited out of half of my position in zero time, and I'm holding the rest because I'm honestly looking for 910. So I have another limit order at 910 for the other half of my position. Now, I don't know if it's going to be hit. I've already moved my stop loss to the other half in my profit. Actually, I've used this low as resistance. I've given it a little bit of a leeway as well. So I've traded my stop at 1,030. So even $16 in profit for the other half of my position. So I don't care anymore. You know what I mean? If it goes to 910, super. If it doesn't, it was still a good trade. I will have made money on both halves of my position. But this was technically a much cleaner position. So I said to myself, like, look, why should you just trade gold as well? I mean, palladium looks so beautiful. Just forget about gold and silver and go with it. And I think it was the right decision. Okay, let's have a look at questions. I'm pretty sure that we must have several. Let me open the question box. Okay, here it is. And what's Aussie retail sales on Tuesday? Misestimates with euro strength potential. What's your thoughts on euro yen? Okay, let's have a look at euro yen. Obviously, euro yen has suffered quite a lot. I said when we were testing the multiple confluences we had at around 131 to 131.50, I said that if this level fails, I really see nothing stopping this pair until we go down to 129, perhaps 128.50. And this is still what I'm seeing here. So I think that we might have like another 100 pips until we actually find some type of like a serious support area, right? So I remain bearish here. Now, the question is the following. Would euro be my preferred short against the yen? Probably not. I think, we've already seen that several of the other yen crosses have been much weaker. So I wouldn't have traded the euro yen to the short side anyhow, because, for example, you know that I'm short Aussie USD. I actually took profits of half of my position yesterday when we hit 77.40. So if I want to be short Aussie USD and I'm not short Euro USD, why would I be, let's say, short Euro Yen and not Aussie Yen, right? So bottom line, as you understand, I think there's more downside to the Euro Yen, but I don't think it's the best opportunity out there in comparison to other Yen crosses, right? Let's have a look at the Pound Yen as well. Here it is. I have to tell you that the technical damage here is now, very significant. You can see here why, right? Unless this proves to be a false break lower, the fact that we broke the 147, 148 zone, if I zoom out, you can see how significant that is as a move, right? Simply put, move lower, move higher. Which of the two looks impulsive to you? This one or this one? Right? I think there is not even a question to be answered here. Pound yen in real danger here. NAFTA concerns hurting CAD and TMXN, which is why USD is holding up well against these currencies. Absolutely, Dave. That's indeed that's indeed the case. Could we please have your comment on the 10-year? Oh yeah, absolutely. And by the way, Dale mentioned it. We posted. Let me show you. Is the market's fixation on bonds justified? Dated 23rd February 2018, right? And what did we say here? We gave the macro perspective. Stelios is always excellent at doing that. We said that bonds have likely more to move to the downside in the longer term, but we focused on saying that in the short term, you can see it here, both the Bund and the treasuries look like they want to reverse higher and take out the weak.
Stelios has quiet, humble wisdom.
Absolutely. 100%.
You're making me blush. Thank you.
100%.
As Blake says, you and I are the saps. We're sappies.
There is
man. Steve, I love you. Stelios, I love you, man.
Oh, the feelings are mutual. There's a saying in Greek, Stelios is ήρεμη δύναμη. I mean, if I wanted to translate that, it would be like something like peaceful force. You know what I mean?
Yeah.
Yeah. So that's what Stelios is. I mean, he's low in tones, etc. But
Bruce Lee of FX.
Yes, exactly. You can say that exactly. And despite being a macro guy, he has an amazing understanding of markets. I mean, his trades are extremely successful.
You love him, man.
Oh, I do. Absolutely. Like a brother.
Send him your 8x10, Stel. Autograph it.
Thanks, Steve. Thanks for your kind words.
We warned back then that keep in mind, guys, that, and girls, that both the bonds are in danger of blowing up in the faces of people that are getting extremely complacent that there is only one way to move, and that way is the way lower. And we had said that even earlier here on FACE, when we were barely breaking out of this descending wedge in the Bund, and the treasuries had not yet followed up in this move, right? So far, everything has been working to plan. We have had rebounds. Especially the Bund one was a more significant one. Now the question is what happens from here? I haven't touched this chart since back then. As you see, I was pointing perhaps to a move towards the 160.50 area here in the Bund before perhaps moving lower once again. So now it remains to be seen if it's actually going to do that. Obviously, especially having to do with the Bunds, what happens in the Italian elections this weekend. Speaking of the Italian elections, we have a blog post about the Italian elections almost ready. We should be putting the last little details on it just after the webinar. So within a couple of hours from now, you should expect it to go live. I think it's very interesting.
Italian accent.
Sorry, I can't do that. Both my parents actually are fluent speakers of Italian, since they actually studied in Florence and they met in Italy. But personally, I don't speak Italian, unfortunately.
Come on, try it.
You did it yourself. That covers me. Okay, so there's going to be an excellent blog post coming out in a couple of hours. We're going to also tweet about it on the Italian elections. In my opinion, you should check it out. I hope it's going to be, as successful as the Bund one was. So what do I see here? Listen, we got a rebound. I think that a lot of the weak shorts, especially in the Bunds, have already got taken out. Now the question is what happens from here. Having to do with the Bunds, I'm going to be looking at this area as a resistance, and I want to see if it's actually going to work out. Having to do with the treasuries, I have to tell you that yes, we did get a rebound out of this descending wedge, but the rebound has been very, very weak so far. Very weak. So I have to tell you that I'm really not inspired by it. I need to see something way more significant to believe that this can extend higher. Let's say, for example, towards back testing the 123 breakout area. As it looks like at the moment, doesn't seem very likely to me that it's going to make it there. Doesn't. What are the values for the green MA? It's a 50. The green moving average, I only use simple moving averages. The green one is the 51, and the blue one is the 200 one.
So, Steve, the longer dated maturities are showing more relative strength than the shorter term, which equals a flattening curve.
Which is a situation we've seen being ongoing for a long time now, right? And it's definitely should be worrying people. You remember we've mentioned that as a fact, several weeks and months ago as well. Closed my Euro Yen short from just above 132 from early in the week. Don't want to hold over the weekend. I totally understand, Dan, that you don't want to take the risk given the Italian elections, etc. I totally understand you. I mean, I have nothing to argue against that. Hey, you probably don't cover nickel, but is it possible to see underneath the rising wedge right now? Frederick, can you please give me? I will gladly have a look at the chart for you. Can you please give me a ticker? Because yes, I've never checked it. So if you can give me the ticker name, I will gladly have a look at it for you. Then we have a question from Abdul on EuroCAD. I doubt that we have much changed about EuroCAD. We actually tagged the 161.8 resistance and we sliced through it. So obviously, the bullish move resumes. As I've said, though, there is no risk reward to be long anymore. So yeah, we are in a bullish move. There's no question about it. We've been in a bullish move since we found a low in February. But, if I was to buy here, where would I put my stop loss? So, I would really, if you're long, great. If you're not long, I would be looking for this ascending trend line for possible resistance. And then, if I wanted to participate in this market, I would be looking, for example, for some type of a pullback towards, for example, this zone before getting in the market, right? Something like that.
Steve, I want to say right before my interview with Jim in a minute that besides your analysis and your trading, that you may not realize it, but you know, a lot of the discipline that you talk about is also mentoring everyone in FaZe. So you have great mentoring skills.
Thank you. I'm trying because you know the ultimate purpose for us is, you know, not for people to come pay for our services and make money, but is to ensure to give back something to the community and ensure the longevity of the market participants. Anyhow, even
that they don't need us, that they just want to be here.
Yeah,
but they
exactly.
don't need us. In case we're retired on an island in 20 years and we're not doing this, and they'll remember what they learned here.
Exactly, and that's why I have to tell you, and you know that might be counterintuitive, but you know, really, I'm not really happy when I see people that become clients that they don't care to learn, that they only care, for example, to use patterns in play to just copy them in their account, and you know, because
well,
you're not,
you know, people have the right to be lazy. So
yeah.
I tell you what,
Absolutely.
what, buddy. Really great week of trading, and you know, I learn from you every day, and you crystallize things for me. So just want to let you know I'm a fan, and have a great weekend. You too, Stel.
Have a great weekend, everybody. And for the rest of the questions that we didn't have time, we'll check them on Monday. Don't forget to check the blog post. Enjoy the interview, Dale. See you all on Monday, on the chat room, of course.
Okay, maybe I'll see you in the chat room for the spare market rally in S&Ps that's starting here. Okay, with that being said, everyone stick around. Jim Welch, I've known for well over 2 decades. It might even be 3. And I've read his writings for that long, and we used to talk every day about markets, you know, intelligence gathering before the internet. And Jim's with us, so stick around for this. Jim, I see you in the room. I'm going to make you the presenter. I'm not sure if you called in on the phone or you're going to use a mic, but I'm really looking forward to what you have to say in these turbulent market conditions. So here you go, Jim. Looking forward to hearing your voice and seeing your screen. Let's see what's
going on. Can you see my screen now, Dale?
Yeah, I don't see your screen, but great. I hear your voice.
How about now?
No screen yet. There we go. You're up.
Hey.
I told you you'd get it.
Well,
all right, Jim.
Folks, but you've made an idiot.
Yeah, well,
Dale.
Welcome
so
back to FaZe. Welcome back to FaZe, Jim. What a great time to have you.
Well, thank you very much. It's a great time to be here. Have the opportunity to talk about markets. Volatility obviously has picked up. I think it's going to continue to pick up. As you know, Dale, coming into 2018, my belief was that inflation was going to show signs of picking up, that the 10-year bond yield would break out above 263 and make a move towards 3%. The 30-year would run up towards 315 to 320, and that would result in a correction in the equity market. All that has unfolded. We've subsequently had a pretty terrific snapback rally, and I continue to believe that sooner or later the S&P will revisit the lows of February 9th in coming weeks as a retest and potentially break through that modestly. So
okay, so a lot of Ellioticians are saying, you know, equality is about 2410 if that happens. You don't think it'll be that deep? More like you know, it was too pat for it to hold the 200-day, and we rallied back 78.6, and you know, you have to shake out those longs first before we get a more sustained advance.
Well, it certainly is possible that the C wave will take us down in terms of equality and cut well below the low on February 9th. I think it's also possible that we finished the rally from 25.32 to the high on Tuesday morning at 27.89 was 3 waves up. So it could be all of wave A. At the same time, it's certainly possible that, let me see, since we're doing this,
that we get a higher low, we get a higher low above that low for a B, and then we have another rally for C. Is that what you're talking about?
You know your stuff, Dale, because that's exactly what I'm talking about.
Okay.
And I don't know if I'll be able to get this screen, because can I minimize this thing on the right-hand side of the screen where it says call in and all the rest of that? Let me just see if I do this.
Well, we see the S&P
okay.
chart. Yeah.
Yeah, okay. So correct. From here to here could be all of wave B. I mean, it is 3 legs. But I think there's also a possibility that this move up, this ABC up, could be A of B.
Right.
And yesterday we dropped down, bounced up intraday, only then to fall again. And we're going to do this to show what that looks like a little bit more.
Okay.
Okay, so here's our ABC.
Right.
Here's A of B. We get a bounce for B, and it's and then followed by another drop down that gets to about 26.40, and then that would complete B of B, and then you'd get a C of B that would take us above the 27.89 from Tuesday morning to complete all of wave B.
And I think that's going to happen.
Well, there's a couple things.
I favor that because I'm out of my bearish position.
not talking from position at all, right?
No, no technical reason. Just huh?
Just because.
Yeah.
All
right. Well, that's an interesting view.
Well, a couple of things. The trend readings or ARMS index have been pretty high the last 2-3 days. So some of the moving averages on the ARMS index have gotten up pretty high. The call put ratio yesterday, more puts than calls. So what I was hoping to see is a drop down to 26.40. I don't know that we'll get it. At a minimum, just take out yesterday's low. And
we did that in the overnight session. We did that.
Yeah, I know. Which always makes it tricky. Futures relative to the cash.
CFDs.
But anyway, that's my outlook, is that potentially we got another leg up here. And the reason why I think this is certainly possible is some of the things we're going to talk about, Dale.
Beautiful. Nice segue.
So, segue
you do
here.
Your own segues too, huh?
Well, let me see. I'm inching this across the way over here.
You're a media guy. So
first
of all, let's talk about that. You're going to go back to your first slide. You're offering free issue of March.
Now, should I pull out my bullhorn here when I do this stuff? Special offer, free.
Do a Kramer. Do a Kramer.
Well, if I did a Kramer, I'd wind up on the floor.
I recommend people write down Jim's email address and check out his March issue. All right, go ahead, buddy.
Yeah, that'll be coming out, if not today, then over this weekend. Basically, the monthly macro tides looks at the fundamental side of the equation, and more so than technical. But I do always try the two together, because I think both disciplines have something to offer. And usually, folks are either on one side of the equation or the other. And I assume that most of the folks that we're talking to this morning, Dale, are technically orientated and, don't do a lot of fundamental. And I really believe that if you make the effort over time to get a better handle on the fundamental, so that you can have greater conviction when you see the technical stuff suggesting a certain move is going to happen. And then you can kind of say, you know what? That makes sense, because I think other people are going to use this information, fundamental information, to take this position and or view. And when you can tie the two together, I think it's most helpful. So anyway, the weekly
it's more powerful. It's almost like confluence between fundamental and technical setups.
Exactly. For me, it's been extremely helpful. I started on the technical side, and then over years of writing this, it's been way too long. It's over 30 years that I've been writing a monthly commentary, and it has evolved significantly as I actually learned a little bit more. It's just, I think it's important. And the weekly technical, as the name implies, is 90% technical analysis, looking at charts, looking at momentum and so forth. But even in that weekly report, I toss in some of the fundamental stuff. And I'll mention something. This last Monday's report, to me, what the charts were indicating is that the bonds were going to rally and yields were going to come down. And we're going to go into detail as to why in a minute on that. At the same time, the chart pattern in the S&P implied a decline. And, stocks and bonds have been moving together more so in recent weeks. And it would seem contradictory that bond yields would come down and the stock market would go down. And the one thing that I pointed to that had the potential of making that happen was Donald Trump protectionism. Last Friday, he made an announcement that, he's leaning toward these tariffs on steel and aluminum. And I think it's a really bad idea. It has nothing politically,
This whole
it's
cabinet,
just economically.
This whole cabinet
Well,
thinks it's a bad idea.
Well, no, you've got Navarro and you've got Wilbur Ross in there that think it's a great idea. On the other side, you got Cohn from Goldman Sachs who isn't on board. History would show that it's a bad idea, but it's a tough situation because there are issues regarding trade where China and some other countries have maybe taken advantage of some things. But you've got to believe that we have tariffs on various products, and we're using some measure of tariffs already to protect certain industries. So it's not like, we're lily white on this issue, but it's a very ticklish issue, and I think it easily can kind of snowball. And so
look how complicated, Jim. Look how complicated it is when the tariffs on solar panels went into effect. It wasn't a tit for tat where they retaliated against the U.S. solar industry. They're penalizing farmers by going to Brazil to buy more of their soybeans.
Exactly. And, that is especially painful for farmers because the last 3 years, grain prices have gone down. And so their incomes have dropped significantly. And now to lose market share through no fault of their own is certainly no big help. In the
because of solar panel.
Yes. So the other thing is totally unrelated, and here's another one. China has said, okay, you do this, we're going to throw the tariffs on soybeans and other agricultural products. The European Union has said, you know what, we're going to target international harvesters. Just so happens International Harvester's main office, home office, is in Milwaukee, Wisconsin, which just happened to be in Paul Ryan's district. We're also going to target bourbon exports from Kentucky, which were more than $150 million last year. Oh, that just happens to be where Mitch McConnell hangs out. So they're all ready to
they're better. They're better. They're more skilled at this game than.
Well, Trump, I guess, said a tweet that trade wars are easy. The guy on this issue alone, I think he's an idiot. I think he pandered to a certain segment of the voting population, and he feels compelled to follow through. Again, the economic fallout is just negative. But my point was that both in the February macro tides, I brought up the issue of trade and the impact it could have on the economy, negative impact. And then on Monday, I was like, hey, the charts are saying the S&Ps are about to go down and bond yields are about to go down. What could cause that? And, it came down to looking at Trump doing protectionism. Initially on that Friday report last week, they said that the decision wouldn't be until April. So obviously they had to rush it to market. Just very quickly, what I look at are sentiment indicators, looking for extremes in terms of optimism or pessimism. And in the futures market, that can really be discerned, pretty concisely by looking at the commitment of traders data and looking at positioning. And then finally, when you see these extremes starting to show up, using technical analysis and chart analysis to identify when we're likely to see an intermediate trend change. And so my focus is more on the intermediate term trend. I know the focus for a lot of folks in this room is shorter term than that, but I think understanding the intermediate term trend so that when you're starting to look at short-term charts, you have a framework and context that you can put various patterns in if you think the intermediate trend is up or down, and I think that can be usually pretty helpful. So the first thing we're going to look at, you and I spoke last September, Dale, and at that time, I had pointed out that the commercials back in January and February of 2017, which is this red line in the middle panel here, had an all-time record long position, while the green line, which is large specs and hedge funds, small speculators, typically trend follower type people, had a huge short position. And I felt that the forces of inflation based on labor market tightness and some indicators that I used were implying that wage growth was about to pick up, and the positioning in the futures market suggested that bonds were likely to rally instead of falling. They did. Then as we got to September, the roles reversed. And I felt that, back last March, I thought that yields were going to be coming down. As we got to September, it was then I thought that inflation would pick up, the positioning had changed dramatically, and I thought that the bond yields were going to move up, as I said before, above 263, make a run at 3% on the 10-year, and 315 to 320 on the 30-year. So we fast forward to
you've called every turn in the bond market the last few years.
Well, thank you. But again, this is where having some idea for the fundamental stuff. So in the January macro tides, I listed why I thought the first quarter GDP was not going to be as strong as people had expected for a number of reasons. The savings rate was down to 2.4%. Consumers had spent a lot of money on credit cards in November, December. They had a great Christmas, but with the low savings rate, that they would be forced to start to pay back some of those credit cards. The tax cut wasn't really going to take effect until February, so it wasn't going to happen on January 1 because the IRS had to have tables going into it. Companies who had made plans to potentially, if the tax plan went through, to do various spending projects. If you're a public company, you then have to have a board meeting, you have to vote on it, and then there's a lead time between the time you vote on something and when it actually starts to get into the economy. And last but not least, the seasonal adjustments by the Commerce Department, for whatever reason, the first quarter has averaged about 1.2% between 2011 and 2017. The other quarters are closer to 2.5%. So all that led me to believe that the first quarter was likely to come in slower. In January, the Atlanta Fed said that GDP was going to be 5.4%. A couple of days ago, they were down to 2.6%. Why? Because a bunch of data have come in weaker than expected. So from a fundamental standpoint, I felt that, all right.
I'd fire those guys. I'd fire them.
Yeah.
Go ahead. Yeah.
I know. That was your Trump invitation.
Well, I mean, what a great job that you get paid a lot of money to be wrong.
Yes, thank God. That's why people go to work in the government.
Yeah.
Anyway, bada bing, bada boom. So the kickoff, I said there's going to be a recognition point when people realize that inflation actually is coming back. That recognition point turned out to be the January employment report on February 2nd, when they said average hourly wages were up 2.9%. So, I was one advocating that, hey, we're about to see wage growth pick up. That number came in, bonds sold off, the market got hit. What I will tell you, though, Dale, is that the hours worked were down about 0.5% due to bad weather in a lot of parts of the country. Statistically, I believe that the shrinkage in hours worked probably goosed the average hourly earnings number to 2.9%, whereas 82% of the workers, non-supervisory people, their average year-over-year increase was 2.4. So my point is, when we get the employment report next Friday, I think it's very likely that we're going to see a year-over-year drop in the wage growth from 2.9, whether it's 2.7, 2.6, I don't know. but I think it's going to be down. And so we spent the last few, absolutely. And so we spent the last few weeks beginning to try to price in a fourth rate hike. If I'm right about that wage number backing off, they'll take that off the table and bonds can rally. So here we look at the positioning again in the futures, just like last February, the commercials have a very large long position in the 10-year. Here they have, you can see a very large long position. The trend followers, they've gotten the message, oh yeah, inflation is going to go up, and so bond yields have to go up, and they're short. And if I'm right, I think we'll see bonds have a pretty good snapback rally. I think the 10-year, we're talking 122 to maybe 122.5. In other words, this spike here, I think is wave 4 of lesser degree, and therefore that's that becomes the target. If bond yields, let me just bring this down here.
So will the weak employment numbers stay the Fed's hand on an interest rate increase in March? Okay.
No, they're going to raise rates in March because, as Powell testified, and again, what he said should not have surprised anybody. The reality is the output gap is gone. This is, again, something that I've written about over the last couple months. The output gap is gone. If you look at capacity utilization, we're also getting pretty tight on that. The labor market is tight, not just because the U3 rate is down at 4%. The spread between the U6 rate and the U3 rate, which is something that I developed a number of years ago, has shrunk now to about 4%, going back to 94. Whenever that spread has gotten down to 4% or below, that's when average hourly earnings have accelerated. That happened in the October employment report. So the Fed is going in March. Whether they're going to go 3 or 4, they don't know. I mean, that's the reality. They're going to follow the data. They've been waiting for wage growth. Yellen said, gee, it's a mystery why we haven't had more wage growth and inflation. So these folks are scratching their heads. They're going to have to see the numbers to come in before they do it. But we know there's fiscal stimulus coming. The budget deal added another $300 billion. So there's upward pressure coming on the economy as we get into the summertime that I think is going to cause bond yields to go up again. But in the short run, based on the pattern, I thought that bond yields could drop from the highs we saw last week and potentially drop 25 basis points or so. On the 30-year, there's a gap around 3%, 303, I think, something like that. You can see there's a gap on the 10-year. So again, getting back down to, or getting up to 121, 121.5, I think is possible. So this was kind
Where's the gap? Where's the gap come in ballpark on the 10-year, on the yield chart there?
On the yield chart, that looks like,
I mean,
do this there.
Okay.
Let me go here. Pick up this. Move this real quick.
Around looks like
the
around
gap on the
265.
265. So here's the other thing from a chart standpoint.
Coming back to check the breakout.
Exactly. That's right where I was going to go. Is that so often 263 was the breakout. Getting above that is what kind of set everything in motion in the last part of January. It's very common for markets to break out, go back down to what I call the scene of the crime, and then resume their advance. So whether they're going to get all the way down there, I don't know. Okay, I just felt that we were going to see a move down that would probably take the 10-year down below 270 or so. And then if I'm right, there's another push up coming in bonds, and the long-term target that I have is 333. And here's how you get there. From the low of July of 2016 at 134, call it, rallied about 130 basis points, right. 262. The low in September, 203. If the two legs are equal, you're at 333. So I think as we get it closer to mid-year,
what if the third leg is, what extension?
1.618. Here's what we don't know, Dale. Okay?
You think Jim knows me? All right, go ahead.
Dale,
that would take it to 4. That would take it to 4.
That would. So again, from a positioning standpoint, what I want to see is if in fact yields come down towards 2.7 or so, I want to see how much the large specs are squeezed out, how the commercials then flip back to where they go from having a big long position to a net short position. And if all that comes into play, then obviously you got a position for a move above 3% and potentially up to 333. And as you get into that move and the dynamics of that move, potentially then stretch it to the 1.618. But it's hard to know that until you get in there. But the point I was going to make, Dale, is as we get above 3% or so, you have pension funds, insurance companies that need to generate income for the various products, for the pension plans. So you have a whole group of buyers out there that are going to, jump on 3.25 on the 10-year, because you look at it the last bunch of years, 3.25 looks like nirvana. Now, one of the triggers I believe that's going to happen to trigger this move up is the ECB is going to do two things. Right now, they have inflation tied to their QE program. Their inflation rate is not getting to 2% anytime soon. They've said they're going to review the $30 billion a month, before the end of September, because right now it's stated to go through the end of September. I think what we're going to see is a two-step. Somewhere as we get late second quarter, maybe early third quarter, they're going to drop the linkage between achieving the 2% inflation and continuing the QE program, because A, they're doing QE at a time when GDP is growing about 2.4% and inflation is trending higher. So there's a mismatch there between the level of accommodation and the suppression of interest rates and what's actually happening in the economy. So I think the next move up is going to be accompanied by the German Bund starting to break out and make a move toward 1% or higher. And as Bund yields go up, they're going to drag the U.S. Treasuries up. So I think if we're going to get that 1.618 or at least the move to 333, it's going to be coincident with Bund's moving aggressively as bond traders, front run, if you will, the ECB. The point I've been making for months is, when QE was in full bloom, institutional bond managers were riding the coattails, and they were happy to do it, of the central bank buying, because it meant, hey, we're on board, you're driving bond prices down, bond prices up, yields are going down, and we're going to be able to be on that trade and make money. But as they exit QE, all of a sudden they're at counter purposes to the central banks, and the net result is, it's every man for themselves. And I think they're not going to wait for the ECB to announce that, oh, by the way, we're cutting our QE program in September. They're going to head for the exits before that comes to pass. And so that's why I think late in the second quarter, early in the third quarter, the European bond market may move quickly. Okay, so here's the euro. I think that's the next big trade that's setting up. Again, positioning back at the lows in December and January, December of 2016 and January. You can see the commercials had a very large long position. The trend followers were big time shorts. It was one of the reasons why I was looking for the dollar to top as we got into January 2017. Bullish sentiment toward the dollar was 90% bulls, and obviously we've seen a decline. Since then, you can kind of see the waves, 1, 2, 3, 4, and here we are in wave 5. 1, 2, 3, and where does that leave us? So from the lows, 1, 2, 3, and on February 16th, you had a key reversal day. I actually went short the euro that day because
I saw that trade. Yeah, so you caught this little dollar bounce we had.
Yes, but I did it via short the euro as opposed to being long the dollar. I felt a little bit more confident, and I could, for me, I could do a 2-to-1 ETF short the euro, and that's what I wanted to do. So, but what is possible here is that here you got 1, 2. This is for wave 5. 1, 2, 3. This is possibly an A, B. So instead of this being 5, this is B. This recent drop could be C. So when that announcement on Trump yesterday came out, I covered my euro short because I thought, you know what, that's not good news for the dollar. And I think the dollar's going to make an intermediate low. I think the rally in the dollar.
Did you get long euro?
No.
Okay.
I'm looking for that again. I'm looking to see. This is the difference in terms of time frames.
All right, so you're looking for a 5, one more shot up.
One more shot up, and this could wind up being a triangle where it goes up and then goes down and then up again. But from a position standpoint, I want to look to go short the euro because the bigger trade is if it gets up to 120. And I'll go back to this chart. This is a trend line that connects the high in 2008, 2011, I believe, 2014, as we see here. And so to me, this comes in around 127 to 127.50. So there's the potential it could bounce up there. But my perspective is I want to go short here because I think the euro is going to drop all the way down to 116 or so, this wave 4 of lesser degree. So I'm looking for a move of 9 to 10 points potentially on the euro as opposed to 40 or 50 bips. So again, I'm looking more at an intermediate term. And I think where it can be overlapped with the trading that you folks do is a core position. When you identify a trading low, I was looking for the dollar to decline, the euro to rally back in December, January of 2017. So, to me, this is where you can layer in, okay, I feel confident that we're going to have a big move here. And you have a partial position, maybe it's a third of what a position that you hold until you get closer to this and do your other trading on top of that. But I think it's important, if possible, to identify these intermediate highs and lows so you know whether the wind is at your face or coming from your back. And so, to me, playing alongside here, again, is it a scalp? Yeah. There could be a couple 100 to 300, point move in the euro if it in fact gets up near 127. But for me, again, I'm looking at it in terms of positioning. If I'm right about this and the dollar does make a low in the next month or so as the euro tops out, then I think potentially as the dollar rallies and interest rates start to go up, I think things like emerging markets could be especially vulnerable to a fairly good-sized setback. There's about $10 trillion of dollar-denominated debt in the emerging markets. So if you get a combination of a stronger dollar and higher interest rates on that dollar-denominated debt, that starts to put a real squeeze on emerging market companies. And again, I think that sets up a trade of going short the emerging markets at some point. So,
anyway. Jim, do equities like a strong dollar or a weak dollar? I say weak, helps nominal gains and takes pressure off commodity markets. Are you in that camp in a strong dollar, or does the market like a weak dollar and a strong dollar?
I think there are other considerations of and beyond the dollar that are more important. Things like obviously interest rates, what's going on with the economy, and so forth. But I think about half the S&P sales are internationally, 45%, something like that. So a weaker dollar is beneficial to them in terms of competitiveness. Makes U.S. products more affordable. So it helps probably more on the bottom line if the dollar is falling as opposed to rising. So,
thank you.
Yeah. All right. That's all I got, Doctor.
Okay. So is that your last chart?
Well, we already covered the last chart here in terms of the very, very short term of the euro, looking eventually potentially for a move up. So if you go long here, obviously this is where your stop has to be. It's that simple.
Right. Okay. Nice looks, Jim. Great interview.
Great.
You want to put up your contact information one more time?
Sure.
And you can also follow Jim. There's Jim's Twitter handle too. I noticed that some people have been following your streams they mentioned in the community So I'd get Jim's March letter, although I think you have a nice preview now, but it's actually something that you could save and read again. And, you know, that's going to be a very instructional video for people to watch too, Jim. So I'll get a copy of this to you. And,
thanks, Dale.
Know that I respect your work and always, you know, considered you to be a friend. And I'm glad that I was able to talk to you, and thanks for coming in today and crystallizing some markets for everyone here.
Well, thank you, Dale. Thank you for the invitation and offer. You know, you and I both love this stuff, you know, that's why we've been doing it as long as we've been doing it, because the fascination, the stimulation that you get from following markets, I don't think there's anything like it. So I appreciate the opportunity to kind of go through some of the tools that I have used that help me, and I hope that they are indeed helpful for your audience. And again, thanks again, Dale. And yeah, we go back a long way, buddy. I think it's 1990. I think it was. We were both being interviewed on the Business Channel in LA, and you rang me up one time, and you know, we've been good buddies ever since. So long time.
Yeah. So you know, this isn't someone I just met yesterday. Anyway, take advantage of the offer. For Jim, have a great weekend, Jim, my trading warrior brother, and good hunting. And let's get back together another couple months and see how things unfold. Okay.
Sounds like a deal. Thanks, Dale. Take care.
All right, buddy.
And thank you, everyone, for your time and attention this morning.
Okay, Face, have a great weekend. Remember, don't just count your pips, count your blessings. I know everyone had a great week. We're going to kill it in March. And thank you again, Jim. See everyone on Monday. Enjoy your weekend. Money comes and goes. Time is gone forever. Take it from Jim and me. Make it count. Adios.